Presentation slides content. Topic: Structural foundations of US dollar hegemony, double matrix framework. Slide 1. Title slide. Title: The structural power of the US dollar. Subtitle: A double matrix analysis of global monetary dominance. Slide content: International monetary hierarchy, financial power, and global capital markets. Why the dollar persists as the dominant currency. Structural explanations beyond macroeconomics. This presentation analyzes the structural persistence of the US dollar as the dominant international currency. The focus is not limited to macroeconomic indicators such as the GDP, size, trade balances, or fiscal policy credibility. Instead, the analysis evaluates the institutional architecture of global capital markets and the structural demand for dollar-denominated financial assets. The double matrix framework demonstrates that monetary dominance is embedded in financial market structure, investor behavior, and global reserve management practices. The persistence of dollar hegemony is therefore better understood as a systematic outcome rather than a temporary geopolitical advantage. Slide 2. What is currency hegemony? Title: Understanding currency hegemony. Slide content: Dominant currency in global system, used internationally for trade and finance, store of value for institutions, reserves asset for central banks, medium of exchange across borders. Currency hegemony refers to the dominance of one currency within the international monetary system across multiple economic functions. A hegemonic currency serves as a unit of account for pricing global goods, a medium of exchange for international transactions, and a store of value for private investors and official institutions. The US dollar fulfills this role simultaneously, creating a systematic advantage that reinforces its global position. The more widely a currency is used, the more attractive it becomes, producing, producing network effects that stabilizes its dominance. Slide 3. Functions of international money. Three core functions of international currency. Slide content: Medium of exchange in trade settlements, unit of account in global pricing, store of value for investment portfolios, reserve assets for government, benchmark for financial contract. International currencies perform three fundamental economic functions. First, they operate as a medium of exchange in cross-border transaction, enabling efficient trade settlement. Second, they function as a unit of account, providing a consistent reference for pricing goods and services as well as financial contracts. Third, they serve as a store of value, enabling investors and institutions to preserve wealth over time. The dollar dominates across three functions simultaneously, while significantly increases switching costs for global actors considering alternative currencies. Slide 4. The double matrix framework. Double matrix analytical model. Slide content: Links currency functions to economic agents. Private sector and official institutions add financial assets as global commodities. Explains structural demand for dollar assets and expands traditional monetary theory. The double matrix framework expands traditional international monetary theory by introducing a second dimension linking currency functions not only to economic agents but also to asset classes. The traditional metric categorizes currency use between private actors such as multinational firms and financial institutions. The traditional matrix categorizes currency use between private actors such as multinational firms and financial institutions and official actors such as central banks and governments. The second matrix dimension incorporates financial commodities such as bonds and equities. This analytical extension demonstrates that the demand for dollar denominated securities reinforces the structural demand for the dollar itself. Slide 5. Financial assets as commodities. Financial securities as commodities. Slide content: Bonds and equities act as a store of value. Financial assets traded internationally. Investors demand liquid securities. US markets provide largest supply. Financialization reinforces dollar demand. Financial securities have evolved beyond their traditional role and infrastructure of borrowing and investment. Bonds and equities now function as globally traded commodities that provide liquidity, security, and predictable returns. Institutional investors allocate capital internationally in search of safe and liquid assets capable of preserving value during periods of volatility. US financial markets produce the largest volume of these securities, generating structural demand for dollar denominated assets and reinforcing monetary dominance. Safe haven dynamics. Slide 6. Dollar as global safe haven. Slide content. Capital flows into US assets during crisis. US Treasuries market provides stability. Investors provide liquidity and predictability. Crisis behavior strengthens dollar dominance. Safe asset scarcity outside US. During periods of financial instability, investors shift capital towards assets perceived as safe and liquid. US Treasury securities are considered among the safest financial instruments globally due to the credibility of US institutions and the scale of US capital markets. Historical evidence demonstrates that the demand for dollar denominated assets increases during crises, even when crisis originates within the US financial system. This paradox highlights the structure of scarcity of alternative safe assets capable of absorbing large amounts of capital. Slide 7. Role of central banks. Title: Central banks and dollar reserves. Slide content: Governments hold dollar reserves, protect exchange rate stability, hedge against capital volatility, support financial credibility, reinforce dollar demand globally. Central banks accumulate dollar reserves to manage exchange rate volatility and maintain macroeconomic stability. Holding dollar denominated assets enables government to intervene in foreign exchange markets and protect domestic economies from speculative capital flows. Because global trade and financial contracts are often denominated in dollars, maintaining dollar reserves reduces transaction costs and stabilizes expectations. This practice reinforces global demand for dollar assets and strengthens the currency's structural position. Slide 8. Network effects in currency dominance. Network effects and path dependencies. Role of central bank. Central banks and dollar reserves. Government hold dollar reserves to protect exchange rate stability, hedge against capital volatility, support financial credibility, reinforce dollar demand globally. Central banks accumulate dollar reserves to maintain exchange rate volatility and maintain macroeconomic stability. Holding dollar denominated assets enables government to intervene in foreign exchange markets and protect domestic economies from speculating capital flows. Because global trade and financial contracts are often denominated in dollars, maintaining dollar reserves reduces transaction costs and stabilizes expectations. This practice reinforces global demand for dollar assets and strengthens the currency's structural position. Network effects in currency dominance. Slide 8. Network effects and path dependence. Slide content. Widespread use increased currency value. Switching costs discourage alternatives. Financial contracts denominated in dollars. Global markets standardized around dollar. Dominance becomes self-reinforcing. Currency dominance exhibits strong network effects, maintaining that the utility of a currency increase as more actors adopt it. When trade contracts and financial derivatives as well as international reserves are dominated in dollars, switching to alternative currencies become costly and operationally complex. This creates path dependence in which historical adoption patterns shape future decisions. Once a currency achieves widespread adoption, displacement becomes a structural deficit. Slide 9. Why competitors struggle. Constraints on alternative reserve currencies. Slide content. Euro lacks unified fiscal authority. Renminbi limited by capital controls. Smaller capital markets lack liquidity. Institutional credibility varies globally. No equivalent scale of safe assets. Potential alternatives to the dollar face structural limitations that prevent them from achieving equivalent dominance. The Eurozone lacks centralized fiscal authority capable of issuing large quantities of unified safe assets comparable to US Treasuries. The Chinese renminbi remains constrained by capital controls and regulatory uncertainties, limiting investors' confidence. Other currencies lack sufficient large and liquid financial markets to absorb global demand for safe assets. Structural limitations therefore constrain the emergence of viable competitors. Slide 10. Structural power of capital markets. Capital markets scale as source of power. Slide content. Size of US financial markets unmatched. Deep liquidity attracts global investors. Standardized securities reduce risk. Efficient capital allocation mechanisms. Financial scale reinforces monetary power. The scale and liquidity of US capital markets create structural advantages that extend beyond macroeconomic indicators. Investors would prefer markets capable of absorbing large volumes of capital without generating excessive price volatility. Standardized price instruments reduce informal asymmetries and facilitate efficient portfolio allocation. The size of US capital markets ensure continuous demand for dollar denominated assets, reinforcing the structural power of the dollar within the global economy. Slide 11. Implications for global economy. Consequences of dollar dominance. Slide content. Global financial stability is tied to US markets. Emerging markets dependent on dollar liquidity. Monetary policy spillover effects. Financial crises transmit globally. Structural asymmetry in economic power. Dollar dominance generates asymmetric power relations within the global economy. Monetary policy decisions in the United States influence global liquidity conditions and capital flows. Emerging markets remain vulnerable to fluctuations in dollar funding costs and shifts in investor sentiment. The concentration of financial power within US markets amplifies the global impact of domestic economic policy decisions. Structural dependence on dollar liquidity therefore shapes global macroeconomic dynamics. Slide 12. Conclusion. Persistence of dollar hegemony. Slide content. Structural dominance embedded in financial system. Large capital markets sustain demand. Network effects reinforce stability. Limited credible alternatives exist. Dollar dominance likely to persist. The persistence of dollar hegemony reflects the structural characteristics of global financial markets rather than temporary macroeconomic advantages. The double matrix framework demonstrates that monetary dominance is reinforced by the interaction between financial assets, investors' behavior, and institutional credibility. Unless competing economies develop capital markets capable of producing equivalent quantities of safe and liquid financial assets, the dollar will continue to occupy a central role within the international monetary system. Thank you very much. The presentation was presented by Protia Chaudhary.